Hey, good morning, everyone. Marty Mazzori here. It's the 5th of June, 2021. This is your macro update. Going to go through that part quickly. Then I'm going to get to some highlights from the blog this week, which I think are very important. I often do that on the main weekly message, but frankly, about twice as many, sometimes more than twice as many folks click on the videos and watch the videos as opposed to click on the written blog. And there's some important key points that I want those who are interested enough to watch the videos, for example, to really understand, particularly clients, so they know what we're thinking and why. So in front of you is the simple graph of our own macro index, 49 inputs. It was telling, back here in late summer 2019, we started hedging portfolios, market fell apart, the hedges worked beautifully. Got a little aggressive right here, that paid off, but then pretty much lost faith in the market. Really expected your classic retracement, then rollover, as truly economic conditions were dictating. Then we break down through these levels and we have kind of your classic, bear market that comes every few years and stocks get back, 50% of their value or more. We've talked a lot about that, talked a lot about the frequency of those events the last couple of decades. But that's not what happened. What happened is this, and of course we've spent oodles of time talking about the Fed essentially breaking their own laws and buying junk bonds and really giving the kind of support to the market that was really not possible if the rules were followed. And I think that has a lot to do with what's happened here, not to mention $10 trillion worth of money printing, right? So anyway, after 3 weeks of decline, we actually went up a couple of points to 39.58, which is a nice solid score. So again, make no bones about it, economy is moving higher. I mentioned the 10 trillion. It's hard to talk about the economy moving higher without acknowledging that without all of that global central bank money printing, I think 100% we would be in some pretty dire straits right now. And you're going to get here, particularly when I highlight from the blog, and I'm also going to quote from a book I happen to be reading this morning, which ironically is very relevant to what we're experiencing right now. In the meantime, weekly mortgage apps, interestingly, because we know about this strong housing market, they keep rolling over. In fact, they're breaking through what has been, some resistance for a long time, then support more recently. I also shared on the blog earlier this week the sentiment captured in one of the major consumer sentiment surveys. The question was, is it a good time to buy a house? And that was at an all-time low, meaning terrible sentiment. Obviously, it's not because folks don't have any money, it's because house prices have gone through the roof. I also showed that traders are net short, and they are again this week, lumber, which is interesting, speculators are, and that lumber futures prices are rolling over a bit. Again, that's inconsistent with a hot market. And so we'll see typically higher prices cure higher prices, because when you have such a high price of a commodity, the production of that expands exponentially, and then that takes care of the high price, and then they overdo it and the price comes down. Not happening so far, not happening in a lot of spaces. I've talked a lot about that in metals and why we like metals going forward. The May payrolls number was 559,000, which was a couple 100,000 below expectations, and the stock market rallied. Wednesday, the ADP private payrolls report came in just shy of 1 million, which was 300,000 better than expected, and the stock market sold off on that news. So if you're thinking stocks do well when the economy does really well, you're thinking right, you're thinking fundamentally, and you're thinking probably about how you should think about it. But that's not what the stock market today is trading on. And this happens, and it's happened multiple times over my career, is that the market is focused on the Fed and interest rates. And if this number were 800,000, I think the market would have tanked on Friday, or at least it would have when the news came out. Whether or not people would have bought the dip, of course, we don't know. But that would have put more pressure on the Fed to raise interest rates. And regular viewers and readers know that I don't think that's going to happen for a long, long time. And I'll express that view again here in a few minutes. The all-important Institute for Supply Management monthly surveys, the services sector, the yellow line, that's an all-time high. It's not, this one hasn't been around. As you can see, the yellow line started back here in 97. Literally, the services industry purchasing managers are more optimistic than they've ever been. Then when you dig into the report, you realize they're frustrated as heck because they can't find qualified workers. They're having to pay more to entice qualified workers. That's inflationary. And the price of everything is going through the roof. And boy, are we seeing that in the manufacturing survey, which came in at 61.2. And by the way, anything over 50 denotes expansion in that space. So 61.2 is up a little bit from the previous month. It's a great number. It's very optimistic. I shared with you on the blog last week the 10 featured commentaries in that report. Again, a lot of optimism, but then on the other side, such a tough time with labor and a hugely tough time with input costs that they are beginning to pass through to the consumer. Heavy truck sales rebounded nicely this last month. That, of course, is an unambiguous positive signal about the state of the economy currently. And then the commodity charts that I've been showing you pretty consistently of late. The Bloomberg Commodity Index, which is just a big basket of various commodities. I pointed out these flag patterns that we're building. These are very bullish patterns. You have a big, strong upswing, then you consolidate kind of at this angle, then you upswing again. Typically, the price target is the length of the previous flagpole. Things got short in here. I mentioned in here we were overdue for a correction. We got it. I expected more, frankly. I really did. And here we are bouncing out of that. Now it looks like we're off and running. You would set a price target right here. And you continue to buy commodities if you're a short-term trader with that pattern. Zeroing in on copper. Here we had our, again, isn't that something? Same kind of thing. Real clean here of late. Flag pattern, exact flagpole, rolled over here. Here, we overshot, rolled over, and the flag pattern began in here. But copper actually hasn't busted out quite yet like the rest of the commodities have. So right here, we're testing this. And I said last week, asked the question, could we go way, way down here before we go back up, which is what I ultimately anticipate. And I said, oh, absolutely. In fact, it wouldn't surprise me in the least. So folks, we are definitely investing with a bias toward inflationary assets and green energy assets, that sort of thing. And a lot of that is just your basic commodities and metals and so forth. And there's reasons to be bullish going forward. I'm going to really emphasize that here in a second. But boy, there's going to be some volatility, particularly when we get these crazy parabolic moves to the upside. And then lastly, with the chart, you recall last week we painted this bullish falling wedge right here. We had bullish divergences, and we were just beginning to break out. And I said, now, these patterns work beautifully with currencies. If I were trading currencies on a technical basis, I would make big bets. And I've always sounded confident. Here, I was confidently bullish. Here, I was confidently bearish. This time, you would think I'd be confidently bullish, but what did I say? I said, I said I would actually short it or sell it right here at the 50-day moving average. And sure enough, Thursday, we hit that. Friday, we fell off of that pretty hard. Could we this coming week pierce through that? Of course we could. Then I would short it at this resistance level right here. I just have a fundamentally bearish view of the dollar going forward. So I'd be very, very careful taking long positions, except on a short-term basis as, let's call it, a swing trade. If there's any traders watching this who are trading the dollar index. Otherwise, though, I'll be very surprised if we're not sitting here in the weeks, months, and years to come with the dollar notably lower than it is here, and if not, certainly not notably higher. And if we are looking at a notably higher dollar, we're looking at a stock market that's experiencing a phenomenal degree of pain, which is why we should expect, because of what that would do overall to the economy and how the policymakers would view that, we should expect a weak dollar, if not a substantially lower dollar, for far into the foreseeable future. So now I'm going to read from the blog highlights, and I'm going to elaborate a bit here as well. Yesterday morning in the morning note, I titled it All the Cover the Fed Needs and My Advice to a Student Trader. So I got a call from a young man who I adore, who's just a dear family friend. And he just had to talk to me because he just killed it the day before on AMC. He made more money in one day than he ever dreamed of. And wanted to know what I thought. And I warned him. I said, hey, you probably are going to not like my advice, right? And I tried to talk to him a little bit about bubbles and so forth. And then I said, maybe, you start thinking about pulling your initial investment and simply playing with the house money from here. Now I'm reading from the text. I also recommended that if indeed trading markets is something he sees himself seriously doing going forward, that he slow way down and start thinking of himself as a student, not remotely as a trader. And to begin with, read these two books, this one in particular, Reminiscences of a Stock Operator and Popular Delusions and the Madness of Crowds. Gustave Le Bon's book, The Crowd, is a good one. There's several of them. I love The Great Crash in 1929. That really gets into crowd mentality. There's a new one out that I bought that's on my list I haven't gotten to yet. That just is going to give you the history of tulip bubbles and all these kinds of things. But from The Madness of Crowds, men, it has been well said, think in herds. It will be seen that they go mad in herds. And they recover their senses slowly, one by one. And then I just touch on the fact that these are ancient books. Reminiscence was written in 1923, Madness of Crowds in 1841, and it's just a good lesson that human nature really pretty much doesn't change over time. And the essential relative quote in Reminiscences was, if I told the average man, sell yourself or short 5,000 steel, he would do it immediately, particularly on the advice of Jesse Livermore, the character in this book. But I tell him that I'm bearish on the market, on the entire market, and give him my reasons. He doesn't listen. In fact, he just stares at me and wonders why I waste his time. The dude wanted a tip, just like Wall Street loves to give out. And Jesse Livermore never gave tips, by the way, and he never took tips either. Coincidentally, this morning, actually, I was reading Ray Dalio's book, Principles, and is it interesting? He gives a really nice accounting of his own experience. Started trading when he was 12 years old. Here he talks about his own experiences. As the stock market continued to climb, World War II and the Depression seemed like distant memories, and investing seemed like simply a matter of buying anything and watching it go up. And folks, a mammoth crowd actually think that's how the world works today. It would certainly go up, the common knowledge held, because managing the economy had developed into a science. After all, stocks had nearly quadrupled over the previous 10 years, and some had done much better than that. Right? You think we were talking about today. In 1966, my senior year of high school, the stock market was still booming and I was making money and having a blast. Of course, I didn't know it then, but that year was to be the stock market's top. After that, almost everything I thought I knew about the markets was proven wrong. Sadly, folks, my best guess, in fact, I highly suspect that there are a lot of folks out there who are selling things like cryptocurrencies and meme stocks who will likely live to tell this very same tale as Ray Dalio, who, by the way, manages the largest hedge fund in the world, which he started out of a one-bedroom apartment and is considered one of the top 100 most influential people in the world and certainly one of the wealthiest, and a really fine human being who spent a great deal of his time the last couple of years writing a wonderful book, not on investing, but on principles and how to run a business, and attributes his success not to his prowess around markets, but to his principles. And then more excerpts from that book. Meanwhile, thanks to the wave of money printing, now this is where it's going to sound familiar to today as well, that had followed the demise of the gold standard, right? Nixon took us off the gold standard. The economy and the stock market were soaring. Stocks were in again in 1972, and the fashion at the time was the Nifty 50. This group of 50 stocks had fast and steady earnings and were widely believed to be a sure thing. In 1973, the stock market took a dive. Once again, I was blindsided. But in retrospect, I could see that the dominoes had fallen in a logical sequence. In this case, the debt-financed overspending of the 1960s had continued into the early 1970s. The Fed had funded this spending with easy credit policies, folks. This should sound eerily familiar. But by paying back its debts with depreciated paper money instead of gold-backed dollars, the U.S. effectively defaulted. And this is what I've been preaching here of late. Naturally, with all this money printing, the dollar plunged in value. What did we just talk about on the last chart? That allowed for more easy credit, which led to even more spending. The inflationary surge that followed the breakdown of the current system sent commodity prices even higher. In response, in 1973, the Fed tightened monetary policy, which is what central banks do when inflation and growth are too strong. Hence what I said earlier in the video, right? If the jobs number on Friday was really, really good, the market would have come down because people would have thought that the central banks are going to do what they do when growth is too strong. This in turn, and back in 73, caused the worst decline in stocks and the worst weakening of the economy since the Great Depression. The Nifty 50 were particularly affected, plunging severely. You know why I'm concerned about that top handful of stocks that have been knocking it out of the park for over a decade that rest atop the S&P 500. So the lesson, when everybody thinks the same thing, such as a sure bet on the Nifty 50, it's almost certainly reflected in the price, and betting on it is probably going to be a mistake. I also learned that for every action, such as easy money and credit, there is a consequence, in this case, higher inflation, roughly proportionate to that action, which causes an approximately equal and opposite reaction, and market reversals, particularly when the Fed wants to thwart that inflation with higher interest rates. I was beginning to see things happen over and over again, which led me to see that most everything is another one of those. Most everything has happened repeatedly before for logical cause-effect reasons. Of course, being able to both properly identify which ones of those are happening and to understand the cause-effect relationships behind them remain difficult. Though most everything seemed inevitable and logical in retrospect, nothing was nearly as clear in real time. This scenario, though, is a little different than what I've been presenting here in of late. The scenario I've been presenting is all of this except Fed aggressive tightening, right? And Ray Dalio actually, in another book that he wrote a while back called Great Debt Crises, he talked about where we are now, where you do this over and over again, wash, rinse, repeat, until you end up with the biggest, historic government debt to GDP level you can imagine. We have it now. The last time we had it like this was in the 40s, and I've talked enough about that analog, but I know I'll keep going back to it. And we had a period there where rather than raising interest rates to fight inflation, the Fed actually engaged in what we call yield curve control and effectively entered the market. And instead of allowing interest rates to rise to fight inflation, they capped them. And if they hadn't, they probably would have blown up just that ginormous debt bubble. Now we have that on the government end. We have 11 trillion on the corporate end. And that is just hugely problematic. So I don't believe we're going to see the Fed tightening. When they tightened in the 70s, we had far less than 130%, far less than 100% debt to GDP. They could actually do it without bursting a debt bubble at the time. So Paul Volcker was able to, in the late 70s, push interest rates, through the roof and basically create a recession, but stop inflation in its tracks. Not going to happen this time, which makes for that super bullish case for inflation assets going forward. And that's pretty much my message. And again, just this week, just a brief note, as we've expressed, in our view, the Fed has literally run out of choices. I strongly suspect that there's some scary downside volatility across markets to come. Ultimately, they'll have to sacrifice the dollar if they've any hope of keeping these financial bubbles afloat. Even Alan Greenspan said, you just cannot accept the cost of failure when you're the Fed. And then Wednesday, where I said the dollar is the loser. Message here essentially is the worse it gets, right? The more the Fed is going to have to do to keep this bubble afloat, i.e. the worse the setup, the more the top-down desperation to keep financial bubbles afloat. Another great book, Reinhardt and Rogoff, this time is different. They said bubbles are far more dangerous when they are fueled by debt. And I said policymakers full well understand this, which has them breaking with all convention and not to mention Federal Reserve Act law. Keep bubbles afloat. Sadly, that means they get bigger in the process. Lynn Alden does just a tremendous job with her macro analysis. But she just says at the end of a long-term debt cycle, debts get so large relative to the size of the economy that it becomes impossible to deleverage them nominally without crashing the economy. So the denominators are increased. The monetary base, the broad money supply, and nominal GDP with a significant inflation component. So they just do all this to push this with inflation. The mechanism to do this involve large monetized fiscal deficits. So the government deficit, monetized means the Fed prints the money and buys the debt, accompanied by a central bank willing to hold rates low, right? That's that yield curve control that I'm talking about. So obviously Lynn and I are exactly on the same page, which effectively inflates portions of the debt away. And it worked in the 40s, and we got to the early 50s with a lot less than 100% debt to GDP, and they stopped doing their yield curve control, and we survived it. And then just to fast forward once again, I close with this from our internal market log. Amid what may be a period of relatively low velocity of money, how much the money turns over within the economy, and people say we have to have high velocity for inflation. Heavy debt burdens, right, which are not inflationary, you could say they're disinflationary, and technological advancement, which of course is disinflationary, if not deflationary. I still see increasing odds that at long last, we're on the cusp of something. I don't see 70s, inflation. I don't see hyperinflation, of course, but I see structural inflation risk. Increasing populism, we're there. You really can't deny it. That's a serious headwind for global trade in both goods and labor. And it fuels and is actually fueled by growing wealth inequality. A continual stimulating of the economy via fiscal policy, facilitated or monetized, right, by easy monetary policy. And that's going to be demanded by a politically powerful populist movement. China, as you've noticed, is belligerent these days. And by the way, they're trying to be a developed economy, which is a service-oriented, consumer-driven economy, which means they're not going to be providing the cheap deflationary labor. They still need to export. But in fact, if you look at a chart of the yuan of late, it's actually rose substantially against the dollar. A stronger currency is better for your consumer. And that's where China is right now. And I'm not saying you're not going to see them devalue and these kinds of things along the way, but in terms of on a trend basis, China's not there to create deflation like they once were. The fear of bursting present asset and debt bubbles were to implement traditional inflation-fighting measures, thus willing to fall notably behind the inflation curve well into the future. This is the Fed I'm talking about. In fact, I placed 50-50 odds on that yield curve control that I talked about. The trillions of dollar-denominated debt sitting on foreign corporate balance sheets, something like 15 trillion. So folks, if the dollar were to rise as these folks try to service that debt and make their principal payments as they come due, well, they have to convert their own currency to the dollar. If the dollar rises and they have to come up with more of their own currencies, that could be utterly devastating. And I've lived through Latin American, Asian, and so forth currency crises. We could have literally a crisis across many different currencies if the dollar were allowed to appreciate. And then the reticence on the part of producers in the metal space to aggressively expand capacity has to do with where they come from, how bloated they were, and how ugly they were, and how much pain they felt after China went hog wild, up to about 2011, and then the bottom fell out. So we've been in a long-term commodity bear market, and we've just broke through that downtrend. And we don't see much of an impulse to aggressively expand capacity, and we're certainly not seeing it in the fossil fuel space. And that has to do with the current administration. A bunch of leases, public leases in Alaska were just canceled last week. There's going to be tremendous demand for oil, even as we convert to green energy. Make no mistake. In fact, our thesis says higher oil prices, and about 15+% of our U.S. equity exposure is geared in that direction as well. And then just a note on that hot topic of wealth inequality, because that can get people all charged up. But the Federal Reserve actions necessary to facilitate the government largesse that ironically will be aimed at addressing wealth inequality will exacerbate it if it works, meaning markets have to continue to rise. And that explains the debt, that explains the inflation that we've seen and the inflation to come. I know you can talk about COVID, but we wouldn't be here without just an unrepentant willingness to just print money and paper over problems. Folks, thank you as always for watching and listening. I'm going to let you go on that, and I'll talk to you again very soon. Have a great weekend. Bye-bye.